All right, it looks like we're live. Thank you very much, Kelsey. My name is Greg Schoenberg. I am the managing partner of Westcott Capital. I am delighted to have our three guests with us today who are going to explore the intersection of ESG and COVID-19. The specific topic at hand is to just kind of repeat the schedule here. Most experts report that COVID-19 is accelerating ESG investing, but our portfolios with a purpose investments into companies or funds designed to address social or environmental issues, generating strong financial returns along with social good. So with that, I am going to turn it over. Let's start with you, Kat. If you could just briefly describe who you are and who you're with, that would be great. And then from there, we'll get into some Q&A.
Sounds great. So happy to be here. Thanks everyone for joining. I'm Kat Utek, managing partner of Core Innovation Capital, where our whole philosophy is making mercenary returns through missionary investments in financial services and insurance technology.
Great. Love mercenary returns through missionary investing. You should trademark that if you haven't already.
Well, we're trying.
That's good, Kat. That's good.
Okay, so Maya, kind of raised the bar very high.
That's hard.
Over to you.
That's super hard. Hi, everyone. Good morning or good afternoon. My name is Maya Koringal. I am one of the co-managing partners of the Rise Fund within TPG. We are the largest pool of private capital available for companies that are purpose-driven in what they do. So we manage about $5 billion in assets, putting growth capital to work behind companies in financial services, healthcare, education, energy, food and ag, conservation, and a few other categories globally. Really looking back, great entrepreneurs building great businesses that are very, very focused, though, on demonstrable social and environmental good with what they do.
Great. Over to you, Doug.
G'day, everybody. My name's Doug Scott, and I'm CEO and co-founder at Ethic. And we are a tech-driven sustainable asset management platform. So by way of a quick background, obviously, you can tell Aussie background originally, grew up in Australia. Folks were social and environmental advocates, ended up in oil and gas investment banking. So go figure. And just because that's what you do in Australia, you end up in that kind of the world. And so, you know, through years of that experience, it really sort of led me to the conclusion that I wanted to try and direct the intellectual capital of financial services professionals and technologists to help address some of the defining issues of our time. And so with Ethic, that's really our mission. It's helping try to accelerate the transition to sustainable investing. We're based here in New York City, which has been an interesting place for the last couple of months. And yeah, delighted to be here with everybody today.
And Doug, when did you come to the States?
I moved to America about almost 6 years ago. I lived on the West Coast originally and then out here.
Yeah, I feel like your accent isn't that strong, so maybe you're losing it the more.
Yeah, I know. I've heard that a couple of times. It's a bit disappointing, to be honest. Most Australians call me American now. It's just, it's okay. I'll take it as a plaudit. So.
All right. Well, let's level set here for a moment. I think the premise of this topic is that because of COVID-19, ESG and impact investing is going to go off into a new trajectory that long outlived COVID. And I just want to make sure before we dive in deeper, do you all agree with that premise? Or is it possible that if we get a vaccine, we get therapeutics, you know, do you see any possibility that over time we'll sort of return, everyone will go back to work, and we will just sort of turn the chapter on this? Maya, you're shaking your head, so please.
Yeah, so please I think this is here to stay. I think one thing that's important for all of us is, you know, not only COVID, but, you know, starting in the U.S. and then elsewhere in the world, also the social justice movement that's happening, and this burgeoning sense of the great divide between the haves and have-nots, and all of the consumer choices, I think, that are important to the generations that are, you know, younger, that tend to vote with their wallet, I think that this sort of notion of supporting companies and being more mindful about where your money goes to bed every night, and that be in concert with your core values is all here to stay. So I think a lot of what we've seen has been accelerated by COVID, now by the social justice movement. But I don't think this is a passing fad. But there is a lot of work that we need to do as an industry to make sure to substantiate why it's important. So, and I think that's what we're going to talk a little bit about today.
So, Kat, knowing you as I do, you're not afraid to occasionally be contrarian. Do you have any points of view that might be a little bit out of consensus as it relates to the trajectory we're going in?
I mean, I think investors are paying more attention than they ever did. So Maya covered on the consumer side, and investors will cover where the money is. But I think investors have been sitting home for the last 5 months, really looking, spending time with their families and getting different views than they ever probably had before, and said, hey, you know what, maybe I shouldn't be investing in these gaming companies, and maybe I should invest in stuff that actually matters. And this inequality stuff really does matter. So I think that attitudes will shift, and people are learning like what is really important to them. I think what we have to make sure is not to just jump the shark too much. So, you know, with the social justice movement, we've all known for years and years and years that a lot of underrepresented founders aren't being funded. And so for everyone to just start raising their hand now going, oh, I want to do this, I want to do this. Well, that's lovely, but you have to put like a whole process in place, because you just don't want to hand someone money that's like, oh, wait, I want to raise. You want to make sure that they're actually ready to run a business. And so it might mean like, hey, we can't just fund everyone like right now, but why don't we put like a good pipeline? Why don't we put them in accelerator programs? Why don't we get really great minorities, then put them in leadership teams of great companies, let them learn lessons there, and then come out and then spawn. So what I worry is that sometimes people, because they want to put their money where their mouth is, and they do want to, back more Black founders, but they might just be backing people that might not be quite ready yet. So I worry, like the worst thing to me that could happen is, or like in this world, is that people fund people that aren't quite ready, and then some businesses don't succeed, and then 5 years from now they're like, oh, see, that's not like the right type of person to back. And that would be the worst, because I think there's a lot of characteristics of Black, Hispanic, female founders that make them the best founders ever, and they've had to go through so much to get to where they are. But you still need a little bit of training. It's why there's PayPal mafias and Facebook mafias, because people came out of these big corporations. So I don't think we can just start plucking people and going, oh, let's give them money because it looks good right now. I think that has to be part of a longer term view.
So speaking of mafias, Doug, Ethic works with financial advisors, correct?
Yeah, correct.
And so financial advisors sort of form their own sort of unwritten rules, and they've seen market cycles come and go. They've seen bubbles. They've seen investor enthusiasm, and then have that pop, and bad things happen as a result. Do you think that there is any difference between how financial advisors are viewing this period and the future trajectory vis-a-vis the retail investors who provide them with their money?
Well, I think so. What Maya mentioned before about folks. Firstly, the backdrop here is this is not sort of a standing start. ESG is now suddenly a thing in the last 4 to 5 months. I mean, this wave has been coming, at least from the public markets perspective. But what's sort of changed, and a bit like other areas where there's been an acceleration through this instance with a whole variety of parts of the economy, with ESG, I think, and especially it relates to financial advisors, the clients of advisors are at home like all of us are in many ways, and spending time with their family. And during times of quarantine, you reflect on what's important in your life. And especially when you overlay that with all of the racial and social justice issues that are happening in the world. And so from an advisor's perspective, the model is, how do I deepen my connection with my client, especially in an environment where I can't meet them physically? And so with ESG, I think the way Ethic works with a lot of our clients is help create that connection, strengthen that bond, strengthen that client relationship, and use the things that are happening in the world and be able to report on those issues and be able to align the things that are important Everybody has values, and I think this is the time where you can see them come through, and you see people be very sort of more vulnerable about those. And so financial advisors, I think in when we work with folks, that's really the positioning. And there's all types of, alpha and outperformance and ESG as a strength. And there's incredible research and supporting with that. And that, we very much see that as correct. But it also is just ultimately a client connection thing as well. And so for us, a lot of what we try to help our advisors do is to understand what's happening in the world and translate that to how you would invest in a sort of a diversified public equities investment portfolio.
You mentioned ESG a lot, and Maya, I think when we were speaking yesterday, you had made reference to a new rule that the Department of Labor is advancing that explicitly says fiduciaries must put financial considerations of their clients above ESG factors. And without getting into the wisdom or lack thereof of this specific rule, one of the things that struck me about this new pronouncement is that it still puts absolute return and ESG stroke sustainability at odds with one another. And I'm wondering, from your perspective, Maya, in a post-COVID world, are we finally going to get away from this fossilized view that if it's really, really bad for you, it's really profitable, and if it makes the world better, it's not profitable?
It's a great question, and it's an important pronouncement. Again, it's a little bit wonky, so we won't get into it here. But it's at the opposite of what Europe is doing, for example, where Europe is moving in a direction where it is making it a requirement in certain areas for companies to report on, for example, their carbon footprint, and for investors to be able to take into consideration the cost of that, negative of that, when they make their investments. In the US, we're now, moving away from that pronouncement. And, if we have an administration change post-November, you might see the Department of Labor move in the other direction. I think, though, what is important that this reveals is that there is still a lot of mystery around whether ESG or a focus on ESG by companies generates better performance, better returns over time. So this is an important body of work that Doug has been working on. There are academics working on actually providing data and track record which show that companies that are better at ESG actually outperform their peers. We need to be data-driven in this, and in a way that will speak to the Department of Labor pronouncements, which is if you could show material financial association with the doing of the good and that it is positive, we should be okay. But it requires research, it requires data, and importantly, it requires the kind of track record that Kat was talking about. So, I have a little bit of a similar fear that if we are not rigorous about the entrepreneurs that we backed, their training, their ability to build good companies around this vision of doing good, we're going to muddy the waters if we have poor operating and financial results. So I think all of these things have to work in tandem, where we should care more about ESG. We should be better about identifying the economic value associated with ESG. We need to develop the tools to do that. And then we need to show the data to the market so that the market can price this stuff in more effectively. And all of these things need to happen in tandem.
Kat, do you have anything you want to add to that?
Yeah, our whole philosophy, and somehow it was so contrarian, was that the more value you bring to an end customer, the more they keep using your product and service. And so we equated this high customer value to a high enterprise value of the companies. For some reason, it's such a contrarian thing, and to us, it makes sense. And so we do think, for the most part, and especially in certain sectors like in financial inclusion, that not only is it not concessionary returns, but that you do make more money. So again, it's early days, and being able to track impact, we could go into that for hours of why that is sometimes an extremely difficult thing to do. But agree with Maya again. You don't want to just take people that really care and have them go run a business. You really rather just take people that can run a really good business and teach them just to like actually care about things. And so, yeah, I definitely agree. We have to be careful of who we're backing, even in the ESG space.
Okay, well, on that note, I want to ask both you, Kat, and you, Maya, a question. Looking at things from a founder that is pitching you, and you're obviously both very accomplished, but I don't think that either one of you is an infectious disease expert, if I'm understanding correctly.
Not at all.
So I'm interested, when you're evaluating companies over a Zoom call or what have you, how much are you consciously inserting your own view on how long this unprecedented period will last when you're evaluating company? Because we all read the same headlines about how there's a lot of progress being made on vaccines and therapeutics, but if those things don't come to pass, what could be sort of another year of this agony could wind up being 2, 3, or more. How do you think about that, and do you have kind of a default view that you bring to when you're evaluating companies? Maya, why don't you kick that
Yeah,
off?
absolutely. It's a great question, and it is important. It's something that we discuss a lot. The advantage that we have at the Rise Fund, and so Kat should speak to this because Core is more focused, is that we have multiple sectors that we can invest in, and multiple geographies. And truthfully, what we do is we think about which sectors and, in a way, which geographies are positioned appropriately for investing at various points in time. So we do think, and we have heard, that there is potential for a vaccine to be delivered as soon as December of this year. But the logistics of getting that vaccine out through at scale and delivered sort of globally is probably another. So even if medically, we can get to, or scientifically we can get to a vaccine end of this year, it's really not till end of next year that it's more proliferated. And so we have to think about the economic dislocation associated with that over at least an 18-month period, if not slightly longer. What we do then is we say, let's say in financial services, one area that I'm keenly interested in, but I think is going to be compromised, is small business. Small business lending is incredibly, pre-COVID was incredibly difficult in the United States. The PPP and CARES Act events, and there was a lot of attention, and there still is a lot of attention on how small businesses in the U.S. are really suffering. That said, for the next 18, 24 months, credit quality is going to be a huge issue when you think about lending to small businesses. So what do? We position ourselves to know the companies that when we start to see the turn in the economy, we can invest behind a platform that's ready to ride that wave of when the economy turns again. So we think about timing. We think about sectors that we're interested in. Because, again, we're a multi-sector fund, we can go about our work that way and say, okay, we're going to do small business, but we're going to wait sort of 18 months before we step in. And let's focus on other sectors today that are a little bit more primed. So some of our more consumer-focused digital fintech companies are the ones that are seeing a lot of volume and momentum, and we're looking in that areas. Now, the challenge in those areas is that valuations are pretty high because a lot of people are interested in these companies. But we do approach the market in thinking about the COVID impact, the economic effects of it, what timing might look like, and we gear our investment hypothesis and our thematic work appropriately.
But just to be clear, though, your view that you bring to evaluation of companies is, in 2022, the world is going to start looking more normal.
Yeah. that it might take
Yeah.
that.
Okay.
It may, the inflection point may come a little bit sooner, and we want to be positioned for that, but we want to be prepared that it's really not till 2022 that things start to go normal again.
Gotcha. Kat, how do you see that?
Yeah. So we realize we have no idea what's going to happen with the virus or the vaccine. I mean, we have ideas, but no one can really guess when it will be. I think Maya's timing's about right, but we want to be prepared. One, if it goes away sooner, and then also be prepared for this to go a couple more years and to make sure that the companies have enough runway and won't die. So it's really looking at what different niches, like where are their headwinds, where are their tailwinds. So agree that in SMB, I normally wouldn't want to be selling too much software into SMBs right now, except because we can go really early, us investing in something pre-product, pre-market, and they spend the next 12 to 18 months doing R&D. We think now that's perfect, because when it's time to sell, we think the SMBs will be like up and ready to buy new software. And so there's certain sectors that we're aware if it goes a little longer, then those companies are going to have some serious headwinds. But if we think 2022, then now is the perfect time to do like pre-seed and seed things in those areas. Now there's so many tailwinds for our companies like digital banking, right? Because you're not going into a branch now, so why only get paid 0.1%? Why don't you go and join these new digital banks? So we've seen a lot of our digital banking go well. A lot of our insurance companies, people are actually feeling uncertainty. They want to get insurance. It's very hard to get incumbent insurance because it's just hard even to get the forms. It's hard to get like a medical exam. So all these digital first solutions, whether it's on the consumer side, are just skyrocketing, and then if it's on the actual B2B side, you have the insurance carriers who always say they want to go digital, moving quicker than they have ever moved before. So for a lot of our companies, this is like they're thriving in the environment. As we're looking at new companies, though, one of the questions you also have to ask is, okay, are your sales going to increase is your pacing going to increase the way it is, like post-COVID? So let's say this ends sooner than later. Do you have this huge bump just because we're here now, or is this like actual sustainable growth? Is it like a one-time thing or sustainable, right? It's kind of like in the SMB lenders, a lot of them made money. They made money because they were processing the PPP loans and they made a ton of money. Well, that you have to discount because that's, hopefully like a one-time thing, or, it's only going to happen so much. So that's how we're evaluating.
Yeah, Doug, in terms of the advisors that you work with and the firms that you work with, would you agree that sort of 2022 is sort of the default? And if you say yes, then I get worried that everyone has consensus here.
Well, I mean, so I guess you can kind of think of it a little bit differently. In the capital markets, everything's moving every day. So if you're an advisor, the times of turmoil the last couple of months are the busiest times in your existence. And so, even if, like, as I said, I'm no disease expert, as no one on the call is, I think the advisors they're planning about asset allocation and how they're thinking about the next couple of years will definitely be influenced on their perspectives on, when they think that there'll be something available. I think it from a as it relates to the ESG considerations, I think that sort of neither here nor there. I think that the kind of tailwinds now that are pushing ESG forward will continue, and I don't think that vaccine timing will play into that at all. Just to me, it doesn't seem like that's a relevant factor. It's the issues behind the issues here are much more systemic. I saw a nice or a funny caricature which sort of had pandemic with one wave and then climate change with a wave right behind it. Like, to me, the issues behind the issues are going to be there, and I don't think vaccine timing or not doesn't change that planning as an advisor, at least.
Yeah, I mean, without going down this rabbit hole, I think it's a good argument can be made for the fact that what we're going through now is just a warm up for what will happen if climate change is not addressed in a systematic way. But I want to talk about something that Kat said yesterday. I believe you said something to the effect of, I don't know if you said we're in a bubble for stuff that matters, but you most definitely spoke to this idea that right now in the private markets anyway, things that matter are trading at robust valuations. And I guess my question for all three of you is, do you think that we're in a bubble for stuff that matters, and we have too much money chasing too few good deals? Or do we just simply not have enough good deals for all of the problems that we have, and what we need to focus in on is more entrepreneurs focusing on these big, weighty issues that affect society. And once we get more entrepreneurs moving in that direction, the valuation issues will sort of moderate that way. Either one of you, all three of you, please, somebody
I hope
take
something
a stab at
moderates these valuations. But I mean, for years I keep going, this is insane, this is insane. And then COVID, I was like, okay, they should go down like 20 or 30%. And instead they're up. And I understand some of the reasons for a lot just being a lot of money in the market. And also there's certain sectors now you're not going to be investing in, like a lot of S&B stuff, retail, hospitality. So it pushes you more to things that actually end up in our ESG space, and people do care. So you're pushing valuations up even more. I think you're right, though. I think there needs to be more entrepreneurs, and you're watching entrepreneurs that have been successful in like the ad tech sector and now going to do stuff. I know the Flatiron guys were the best example, I think had done Invite Media, a media company, and then did Flatiron Health and really decided, hey, great if we can do advertising, but why don't we like cure cancer? And so I think you're seeing a lot of really successful entrepreneurs go, okay, let me pursue something that like actually matters. And we have so many problems with, financial inclusion in education, in healthcare. So I think there's more than enough room for these big societal issues to be tackled. And I'm excited to watch more people come in. And you know what, even if they do though, I'm still not sure it's going to fix this like valuation bubble. So we'll see.
Yeah, I mean, I'll jump in here. The valuation bubble is concerning both in the private markets and the public markets, because I think that, they're obviously interconnected, and there are a lot of reasons why the public markets are more ebullient than they should be, and I think are not reflecting sort of the economic realities that we will be living in for some time. But to Kat's point, what we need are more entrepreneurs who know how to run business and build good businesses, and heretofore have not been necessarily focused on anything but the profit motive. And we need them to move into areas where they care. If we could move, even if we could take the existing stock of company and push them in the direction of doing better on the E and the S side and the G side, we will move the needle further. So one of the trends that I'm interested in is, there are a growing number of really experienced, more hedge fund managers or activist investors who are starting to come into the market to say, we're going to really look at, public companies and take a massive stake, get a seat at the table at the board, and push the companies in the right direction in terms of better incorporating E and S factors, using their G at the table. And I think that's a very important trend as well, and needs to be supported. So I do. I think it's a combination of these things, but it's urgent and it's imperative. And, I'm sure Doug has a point of view, looking at the public markets all the time.
Well, Doug, if you don't mind, I want to have you be the first person to respond to the next question I ask. We only have a few minutes left here, and there are two more topics I want to get to. You all have mentioned racial justice in one way or another over the course of the last few days in which we've been dialoguing. And, I think it's pretty clear that, society, business, the venture community, everybody has woken up to this issue. But, I'm old enough to remember Rodney King, and I recall a similar amount of enthusiasm for change and a desire for change, and politicians giving good speeches and corporate business leaders giving good speeches. And while right now it very much feels like we are on the precipice of mobilizing the business community to really make dramatic improvements in this area, I am a fair bit skeptical that over time there is a danger we'll go back to our original factory settings when it comes to these issues. And I'd like to kick it off with you, Doug, and have you respond to that and talk about what you think could happen to ensure that that is not the case.
Yeah, I mean, well, you know, the ESG, there's a couple of different factors that play into that. One, I could say from the investment community, and I can certainly speak from the public markets, and I encourage Kat and Mai from the private side. Like in the public markets, ESG now in many investors' mindsets is around this resilience and robustness. And I think that's a different frame of reference. And so I think when it relates to the changes and how we can stop you know, those who don't understand history are doomed to repeat it kind of thing, is essentially a couple of things. And especially as it relates to just racial justice. I mean, I can talk about, for example, how we think about assessing this for our public companies and like how that can therefore help inform the investment, help inform, I should say, the business community to help think about these issues. Because the next generation of talent are not going to be wanting to work at companies that don't have the practices and principles that are sort of best in class as it relates to these issues. And so, you know, the first sort of thing is thinking about the own sort of inclusion and diversity principles and practices within organizations. And it's a lot easier, you know, from a company at seed stage all the way through to be able to instill those when you're at, you know, one person or five people. It becomes increasingly harder to turn a ship that's already going down this, but it's still something. Having actual meaningful goals around these issues is extremely important. The second order thing I think around this is to think about what are the sort of consequences of your business practices that may disproportionately affect communities of color. And so we've talked about lending practices in a couple of different ways, but the lending practices as well, private prisons, firearm retail, there's all these different areas that if you think about the organizations, these will have damaging effects on communities of color. And I think that if we're going to avoid the mistakes of the past, we've got to look introspectively at our own business practices to understand where we might be unintentionally having those impacts. And so for us, you know, I think that dollars, this is my view, dollars, capital dollars and drive, and this is why I think with the DOL question as well, you know, the capital markets is what determines the outcomes here. So I think that there's enough momentum and energy of the investment community that recognizes that ESG considerations, of which social justice is one of the issues, is driving outperformance, is driving resilience and robustness and volatility, that I don't think we're going to turn back on some of these areas, because I just think it's like making a foolish investment decision. You know, that just doesn't happen if you think about the whole market.
That is incredibly well said. We have just 3 minutes, unfortunately, here for discussion. So I just want to wrap up by asking you each for a morsel, a counterintuitive idea you have that perhaps is running against the mainstream of how the world should be approaching COVID-19 that you can leave us with, that, you know, hopefully will prove out as correct. So I don't know who wants to go first. With your morsel, please enlighten. I'll just call on one of y'all if nobody raises their hand.
So I'll go. So this is an interesting, you know, idea and that we've had. We're obsessed with health insurance, and I think if you make sub $48,000 a year, you can go on the exchange plans, and right, we have a company, Health Sherpa, great. They enrolled more than 4 million people in the plans. Average person pays sub $50 a month for a premium. Cool. You have access to like a silver plan, you know, affordable, and you're fine. You know, if you're making over $100,000 a year, you know, going on, you know, a plan like Decent or like Oscar, that's fine. I mean, they're bronze plans, but it's still $500 a month, which is substantial. That's $6,000 in a year. So unless you're making like 100,000 or more, you know, it's really like almost cost prohibitive. So there's a whole gap of people that aren't full-time employees somewhere, don't have access to health insurance, and that are left out because they make between $50,000 and $100,000 a year. It's about like a third of the country. And you know, what do you do for health insurance? And a lot of people don't have it. And so the contrarian thing is, what if you don't actually have a full-blown insurance, but you have more like a health plan, something that literally is a small plan. And we've seen a couple companies do it now where you pay, you know, 30 or 40 bucks a month. It covers some preventative care. It covers urgent care, you know, and has like $100 premium. but that's it. Now it puts you at risk for like cancer, or like you get COVID and you're in a hospital for a while, you don't have that catastrophic insurance. But I think it's like better than nothing. So I think what we're spending time on, and I encourage any entrepreneur, if you're working on this, to reach out to us, is really finding what fills the health insurance gap for those making between $50,000 and $100,000 a year. And it might not be traditional insurance, and that's okay.
But it is possible. That's your counterintuitive idea. It is possible. Maya, Doug, real quickly, anything you want to add?
I'll just leave an adage which people can remember rather than an idea, which is to play on Kat's words in the beginning. It's easier to socialize a commercial person than commercialize a social person. Mm-hmm. So think about that for the entrepreneurs out there, and go to work on socializing the commercial persons.
Mm-hmm. I like that. That's a good one, Maya. I mean, I can't add anything that is more innovative than the venture capitalist folks. I will say, as it relates to our business, the one counterintuitive potentially thing is that ESG is no longer just a sort of liberal perspective, and we are seeing that tremendously throughout other parts of the economy and parts of the world that you would not traditionally associate with ESG. And so I wouldn't call it a counterintuitive idea, but it's certainly a counterintuitive sort of reasoning, and it is really exciting to see.
Well, it's a big idea. And on that note, thank you all for joining. This was a lot of fun.
Thank you. Thanks, Greg, for moderating.
Thanks, Greg.
Bye.
Cheers, guys. Thanks.